Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with the equity market rally losing some steam as President-elect Donald Trump's tariff escalation fuels dollar strength. Stuart Kaiser of Citi writing the following. The focus of markets has been Trump policy and geopolitical events that have shifted risk-specific pricing but not reached critical mass to drive broad-based de-risking. Stuart joins us now for more. Stuart, good morning.
Good morning.
Do you see evidence of that again this morning?
Well, I mean, we'll see how futures react, to the tariff announcements. The market's kind of been on top of this. If you look where volatility markets have been pricing risk premiums, it's been in precious metals, it's been in China exposed equities, and it's been in the currencies. So I think the market has kind of viewed those as key sort of pockets of risk, and they're going to be surprised, I think, by the magnitude of tariffs proposed on what were former NAFTA kind of trade members. So without a doubt, we'll see how the futures react, but this is what we're in for, I think, for the next couple of months.
How credible do you think the threat is? Additional 10% on China, 25% on Mexico and Canada. How credible is that?
I mean, you have to read it as credible. I mean, this is the President of the United States. He increased tariffs in his first term, and this was, part of his campaign. So I think you have to view them as credible. I think some of his inner circle has talked about these being negotiating tactics, and I think that's potentially true. But I mean, a negotiating tactic is only effective if you're willing to use it. So I think you have to view them as credible threats. Yeah.
Which is the reason why headline risk is real, and the reason why you're seeing people trade on this, even if that trade gets faded in a couple of hours because of another headline that comes out. Is this a good time or a bad time to be a trader?
It's a hard time to be a trader, I would say. Look, I think it's a good time in the sense that, good traders like a little bit of market volatility. I think the hard part about these type of things is just the unpredictability of it. It's not, payrolls are going to be released at 8:30 a.m. on December 6th, and I can kind of position and trade around that. This is a little more, kind of random in terms of timing, and also, coming at you from a lot of directions, right? You have traders that are trying to deal with potential impact on healthcare policy, potential impact on food policy, potential impact on tariffs, et cetera, et cetera. I mean, nobody can say this is totally surprising. Again, these were all things that were discussed during the election as priorities to deal with. But no, it's a difficult time, I think, to be a trader unless you get it right.
To build on that, you're talking about how there are specific headlines that have affected healthcare and appointments that have affected the healthcare sector in particular. And you had a great note talking about how different sectors have traded differently from the overall headline in tandem with people's belief. Do you think that one of those moves is stickier than the other? In terms of, say, healthcare, given the fact that some of the potential nominees for cabinet positions have talked about really disrupting healthcare in America.
Yeah, I think, to us going into the election, two of the sectors that were a little bit like wild cardy would have been healthcare and energy, just in the sense that it's hard to decide what's going to go on at like the GICS level 1 sector level. You almost have to go down a level. And even within healthcare, that's the case. Do you have pharma being impacted in one direction, but then you have biotech potentially benefiting from M&A, and then people are trying to hide out in med tech, for instance. So it's a very complicated sector in terms of the policies that are being proposed impact different levels of it as you go around. Energy, I would say, same way. We're going to drill a lot. That might be good for, let's say, pipelines, but it might push the price of oil lower. So I think those two sectors in particular are very complex right now, going to be very, very difficult to trade. In terms of persistent, I think the markets are telling you they think banking is persistent. So I think that is the one that people are comfortable being long, even in a down week. Those the banks are rallying, but I think healthcare and energy are the two that are going to be a little bit more pulled in multiple directions at the same time.
When it comes to healthcare, though, changing policy in Washington, D.C. is like moving a massive tank. It takes a really long time. Would now potentially be a good entry point, given how they have fallen with some of these announcements?
It's possible. I think, our view on healthcare has been that it was going to be difficult trade going into the election. We do think it's a beneficiary of M&A. I think at the top line, the question is relative to the credibility question is, how much of this stuff is sort of more pie in the sky, or maybe RFK Jr. personality things he'd like to get done versus what are they actually going to kind of push through. I think there is potentially there's going to be a time to fade this stuff. I think right now when things are just kind of so kind of uncertain and more of I don't know, wish list that actual policy might not be the time. I think, our view on the election, it's three stages. It's the initial risk-on reaction to the election. Then you have what we're in now, which is nominees and policy proposals. Then you have phase 3, which is probably next year, which is actually policy implementation. I think as we get closer to that is when you can think about kind of fading some of these things.
Well, in this phase 2, this transition, why are U.S. markets taking it in stride and European markets are down across the board?
That's a great question. U.S. markets I think are still benefiting from like the risk-on repositioning part. I think a lot of the policies we've discussed, particularly on the tariff side, are viewed as more, pro-U.S. and kind of hurt Europe, to some extent. And then you have the geopolitical risk, coming out of both the Middle East and Russia, Ukraine. So look, I mean, if there's one thing that a Trump administration is probably focused on is domestic growth, right? America first type situation. So if you believe he is going to be successful with that, then almost by definition, U.S. markets should benefit a bit more. Will that actually come out, in the wash? We'll have to see, but I think that's part of it right now.
What's your read on domestic growth? Two retailers just reporting moments ago. One is Kohl's, the other is Best Buy, both trimming their outlook, downgrading their outlook. What's your read on things right now? Target, I understand, hit a landmine. Big inventory problem. I've got that. You can sit here and say that's a Target problem. What have you seen across the other retailers? What are we learning about consumption and how good U.S. growth actually is?
I mean, it looks fairly solid. Our retail folks, did a big survey pre-holiday spending. It looks like holiday season is going to look pretty solid. So that's a good story on that side. I think it was Williams-Sonoma actually put up pretty decent numbers on their earnings. So it looks like, I think how it's been, which is the underlying growth momentum seems pretty positive, but you're sort of at that level where you get some good news and bad news. And, I think because of that, the bad news stuff is getting punished pretty bad. So I think over the summer we were trading decelerating growth. I think you still have to be trading this as you are at a solid growth level, but you're close enough to borderlines that when you get bad news, you get a ton of reaction. The payrolls are going to be massive on December 6th. My read would be growth is solid, but not exemplary, and we just kind of have to trade it that way. And in those environments, you have a lot of kind of risk, reward, and volatility because you're close to trigger points in a lot of spots.
You talk about how they're winners and losers. The winners being the Walmarts of the world, the winners being some of the big tech names. I want to read some of the commentary from the Kohl's CEO. I thought this was interesting. We are approaching our financial outlook for the year more conservatively given the third quarter underperformance and our expectation for a highly competitive holiday season. Is this a new time where the big are going to get bigger, that anyone who has that platform to basically dominate when it comes to data, when it comes to some of the technological advancements and deliveries, are going to outperform at a time where they can offer maybe better price competition than some of the other companies that haven't had the scope to really expand in that way?
Yeah, I mean, I think that's true, and I think, that also brich the tariff discussion in too, is, are these bigger companies better set up to deal with any potential tariffs than kind of smaller competitors? So yeah, I think the big winning, that's hard to say. You still have to get it right. I mean, Target's a big company, and they clearly got something wrong, just based on the stock price reaction. So yeah, I think it gives maybe a Walmart or an Amazon a little bit of an advantage, but there's still execution risk, right? And you still need to do it and do it well. I'm not under the impression that this is a more competitive holiday season than last holiday season, for instance. I mean, I feel like these things are always pretty competitive. But yeah, there's an advantage there.
I guess the bigger question is, how much of a macro tell are any of these stories, given the fact that there are winners, but there's some pretty big losers who are pointing to competition, who are pointing to a real unwillingness for consumers to buy things if the prices are perceived as too high or if the quality isn't perceived as enough?
Yeah, I think the macro read's been really tricky, I think, because you had a period last quarter when the dollar stores did really, really poorly. And that would seem to have reflected, hey, you're having a lot of pressure on that lower end consumer. But in that same period, Walmart did great. And, there was some discussion, well, that's just because people are trading down to Walmart. And that is actually all bad news. I have my lower end consumer under pressure. I have my medium and high income consumer having to trade down. And I need to be worried about that. But then you get your retail sales numbers and they're okay. And I think this gets back to, John's question, which is economic growth is fine, but it is slowing down to a level where you're going to get some good results, you're going to get some bad results, and that's going to kind of create volatility in the market, and you just kind of need to risk manage around that a little bit.
Is there more, though, anecdotes that more and more consumers are trading down, and potentially that's the start of something bigger?
It does feel that way, but I can think back to the previous August 2023, when you had some weak data out of some of the retailers on their private label credit cards, and folks were saying this is the moment. These private label credit cards are under pressure, and credit balances are rising. So, I mean, the anecdotes, yes, they are stacking up, but I feel like people have been trying to fade this for an extended period of time, and it's always been a little bit too early. So, I think yes, the anecdotes are stacking up, but I'm not sure that that's out of the blue. I think this is something people have been expecting, and it's been kind of an ongoing process. And we're just going to have to, I hate to say it, just wait on the data at this point.
Jobless claims has been a great example of the same thing. So many head fakes over the last couple of summers. We're going into September, October. Every single time we're waiting for this thing to slow down, and then it just doesn't happen. Stu, it's good to see you.
Thank you.
Have a happy Thanksgiving.
You too.
Thanks for catching up with us. Thank you. Stuart Kaiser there of Citi. Turning to Tesla, California Governor Gavin Newsom excluding Elon Musk company from a proposal that would offer EV rebates to buyers if a federal subsidy is repealed. Newsom's office telling Bloomberg it's due to the plan's market share limitations. Musk calling the proposal insane in a post on X. Ives of Wedbush saying this: with the majority of EVs sold in California being Teslas, this would be a risky political move in our view. Dan joins us for more. Dan, good morning.
Great to be here.
Do you agree it's insane?
Look, you had Jake Paul and Tyson. Now you got Newsom and Musk. I mean, this is going to be a battle, right? And ultimately, it's a political battle, but the only EVs that are made in California are Teslas. So if they actually go down this path, I believe this could be some threats where more and more jobs move from Fremont to
Texas.
Austin. But at the end of the day, federal tax, as we've talked about, that's going to get ripped away. That's bullish for Tesla. You're going to see this back and forth.
Before we get into that, let's just dig into this relationship. What is behind it? We know what was behind it with Biden. What this basically came down to was union workers not being at Tesla in a way that they were at GM and Ford. What's this one about?
Look, I think, first of all, Musk was iced out of the Biden administration for years. Right? It was really focused on Detroit in terms of GM, Ford, and others. If you look here, is that there's a beef clearly between Musk and Newsom, but essentially what this is really about is that you are going to have these tax credits from a federal perspective taken away. California clearly trying to do something to stop that, but the reality is that the money ran out on this program in California.
So Dan, this is important. The support at a federal level is clearly with Elon Musk. At a state level in places like California, it looks like because of this tension, he's losing it. How important is that relationship at both the state and federal level when it comes to things like autonomous driving?
State, we view it as much less than from a federal perspective, because the golden goose here is autonomous. We believe the autonomous piece is worth $1 trillion alone to Tesla. Federal regulatory spiderweb essentially gets ripped away, and I think that's significant. Now, California, Newsom clearly will try to fight some of the autonomous, some of the unsupervised FSD, but this is going to be something that's really going to continue. But I believe Tesla is going to have significant sort of room to what I view as elevate themselves within autonomous. And that's really what I believe is the key to this Tesla story. It's about AI and autonomous. What Newsom's doing here when it comes to California, this is essentially almost a sideshow to the broader story here with Tesla, which is why it's really been a Cinderella story since Trump got in because of the Musk bet.
But when it comes to autonomous driving and the federal regulations, it's not a light switch. This has to go through Congress. Elon Musk and his proximity to power cannot just basically get this over the finish line.
Of course, not in itself, but could move it significantly toward the finish line. So he gets it to the 2-yard line. Right now, it's at the 40-yard line. 50, midfield. So he can get to the 2-yard line, but that's also why with the red sweep and just relative to what we see with coming out of the Beltway, being there over the last week, we feel like there's a groundswell for autonomous. But no doubt when it comes to EVs...
You feel there's a groundswell in Congress as well?
I believe there's a groundswell. The reason I think there's a groundswell based on our view and what we hear is because of what's happened in China. because China is now going so far ahead of the U.S. when it comes to autonomous because of the lack of really regulatory spiderweb. That's why Trump, you have an AI czar come in. But who's going to be, from an AI czar perspective, Musk is going to have a front row seat to really everything here. And that's why it continues to be the poker bet for the ages for Musk, betting on Trump.
So basically, and this sort of goes to the heart, in some ways, of the beef between Newsom and Musk, the idea that it's one thing to be transactional in your policies if you're in the White House and you're in Washington, D.C. It's another if you're sitting at the state. And the White House will probably trump that. There is just a question of how far that will go. Do you actually believe that there will be policies crafted specifically to benefit Tesla over some of the rivals in the United States because of Musk's closeness to the White House?
Yeah, I think, look, clearly, Tesla is in just a much different situation relative to autonomous. So they have, first of all, they have the scale and scope on EVs. So you pull the tax credit, gives them a huge advantage just relative, to federal subsidies. But on autonomous, it's their world. Everyone else pays rent, along with Waymo. So when you look at this relative to other automakers, they're essentially almost going to have to license from Tesla. But when it comes to the state level, you look at Newsom, look, does this end up in a UFC fight? I don't know. I mean, this is going to continue to play out between this beef, Newsom and Musk.
This goes beyond just Tesla. There was a report out of The Information saying that Google CEO called Donald Trump and Elon Musk was on the phone with him, and he was surprised by that. You talk about space and some of the space exploration and what's going to happen with the NASA budget. How much can you extrapolate out that the Musk halo is really something that you have to sort of get on the bandwagon as an investor, simply because there are going to be certain policies that will just de facto benefit him because of his closeness with the president?
I think you said it as best as I could say. I mean, this Musk and Trump, this is not going away. I actually see this something that's going to continue to expand. And it's going to be from China tariff discussions. When you look at Musk's ability in terms of President Xi and his relationship there, when it comes to AI, when it comes to autonomous, EVs, that's why it comes down to Detroit. Musk, he wasn't at the cool kids table. Now there's a knock at the door. It's Elon. And I think that's really the issue right now that's starting to happen, is that everyone's starting to realize that this Musk-Trump alliance is going to continue in a lot of ways. Newsom's clearly trying to get into that, but I continue to believe that's probably going to be a battle he'll ultimately lose, because you continue going down that path, okay, more jobs go from Fremont to Austin. Oh, on second thought, maybe we won't exclude them.
So this is Tesla in California. You also cover GM. Mm-hmm. What's your reaction to the tariffs that have been threatened on Mexico, on Canada, given that we know that these automakers have quite a presence south of the border?
I mean, if you're Mary right now, Mary Barr, I mean, here it is. You have Musk that's going to be front row on Trump. Now you got these tariffs. I mean, you talk about heartburn from a GM perspective. Well, for a company right now, that's actually, I think it's some of the best execution that I've seen.
You've still got to outperform on the stock.
Because to me, if you look at execution, I still don't believe the stock is getting the right value relative to...
How exposed are they, though, to this tariff story? And if he goes through with it, can you still put an outperform on that stock?
They're exposed. We got to see how it all plays out. I continue to think that Bark will be a little worse than the bite, in terms of as it all plays out. But for GM, for a company that's humming right now, it's kind of been a little 1-2 punch in that 313 area code.
So GM, the only reason I brought up GM is not about the tariffs, it's about F1, expanding the grid to an 11th team. You went to Vegas over the weekend. What was your impression of things?
I mean, my first F1, and Ferro's had an influence in that. Look, that was just an epic week in terms of just being experienced F1. Being part of the Ferrari team there. It was just an unbelievable experience. I recommend everyone, I went from Ferro to the Netflix show.
John's an influencer now.
He's he's actually an F1 influencer. So I went from Ferro to the Netflix show to going to an F1 race. Next thing I know, it could be in Monaco. You never know where this is going to go.
Are you a signed-up member of the Tifosi now? Are you a Ferrari fan?
I am a signed-up Ferrari fan now. It starts with Penn State, but now Ferrari is part of that.
Okay, that's quite a contrast, Penn State and Ferrari.
But you're talking about both elite.
You're barbelled.
Exactly. You barbell the strategy.
Dan, thank you. It's good to see you.
Great.
Dan Ives of Wedbush. Thank you, sir. Here's the latest this morning. Holiday shopping expected to break records this year, signalling just how much higher prices are impacting consumer spending. Nela Richardson of ADP Research Institute writing higher prices could dim holiday cheer. For a long time, wage growth for hourly employees was outpaced by inflation. Nela joins us now for more. Nela, always great to see you. Welcome back.
Thank you.
What's the outlook for spending this holiday shopping season?
Well, the outlook for spending is at record highs. The National Retail Federation expects consumers to spend $900 per person, per family this year. That's up like $15 from last year. So strong spending this year is expected. But the problem is we're on a knife's edge when it comes to wage growth versus inflation. In fact, we only expect for hourly wages, hourly workers, which are about 60% of the labor market, we only expect their wages to tread just above CPI inflation. So that's like 30 basis points. So as prices are going higher, wages aren't keeping up.
How big is the spread between how consumers say they feel versus how much they do? Because how they feel has been pretty awful for quite a while now. But then I look at retail sales, and retail sales are still really robust. What do you think explains that?
Labor markets. Because even though wages are just keeping up with inflation right now, people are employed. If you look at layoffs, they're very, very low. There's not this threat, impending threat of doom when it comes to what's going to happen after the holidays. Will they still have their jobs? For many workers, they still feel confident about the labor market. What they lack confidence in is in prices. They keep going up higher, and they're already at high levels, and that's what's changing the game in terms of sentiment.
Has there been a behavioral shift where people are being paid, they are employed, and yet they're not levering up? That people still have the specter, whether it's the financial crisis, whether it's just simply this time of high inflation and feelings like you need to get your personal finances under control. You're not seeing credit card delinquencies pick up in a material way. Is there a message from that?
I think there is. First of all, consumers are being a little sharper about their finances, but we can't go too overboard in optimism with the low delinquencies relative to the past. We have to also look at savings rates, which are also low. So we're in this purgatory, if you will, in terms of consumer balance sheets. They're getting by, but they're living paycheck to paycheck. They're not putting away savings at the same rate that they used to. Credit card delinquencies aren't picking up yet. So yes, this is a happy period for the consumer, but it is, again, a sensitive period. You don't know what could sway the consumer into more debt and into less savings than they have been.
It's taken a long time for the average worker to catch up to inflation, and they feel like they've been left behind, and we've seen that increasingly. John was talking about the sentiment surveys. Have people caught up?
No,
what would
not
it
at all.
take? So
Not
what
at
would
all.
it take for them to catch up in a material way with wage gains that could put them at least on the same track they were, or relatively close as pre-pandemic?
Look, we look at data all the time at ADP. We're looking at hourly workers. I was just reviewing 14 million hourly workers and their average pay. For the better part of the last 4 years, the worker has been underwater, meaning their wage growth is not keeping up with the inflation that they're seeing in retail, in consumer price inflation. So we haven't kept up in general as a workforce. There is pockets of light now. We're finally starting to see a little bit of an increase in wage growth above CPI inflation, but it's tenuous, it's vulnerable, and anything could trigger a reversal in that wage growth versus CPI. So no, the worker is not keeping pace. Consumption is being led by wealthy, more affluent households, and the average worker is still trying to keep up. That's why you're seeing lower savings rates, yet not spilling over into delinquencies, and that's going to be the barometer to watch about the health of the consumer.
Yet they're spending more this holiday season. And December last year, inflation was north of 3%. The prior Christmas, it was north of 6%. Is there this idea that the consumer is also just getting more used to inflation?
Well, they are certainly spending like it. I mean, they don't like inflation. They may, rally against inflation when it comes to our sentiment surveys, but it hasn't dented the enthusiasm in spending. What consumers want now is cheaper prices, very quickly goods. We're used to real-time consumption, and they're getting that right now. After the holidays, it'll be a good benchmark for the real status of the consumer. People tend to go over their skis a little bit during during the holidays. Will they pull back in January? Will companies pull back in January? That's what we'll be looking for.
You said that some of the gains are really fragile and that they could be derailed. What would derail them?
Well, higher prices. And if consumers or businesses who are betting on lower interest rates going into the new year don't get that bet realized. There's indications that inflation is sticky. It's not moving down in the straight line that was expected. If we see a stalling in the interest rates, if consumer credit becomes more expensive, if it costs more for consumers to borrow, to buy cars, which are also seeing some price growth, to fund purchases, then that could stall some of their spending behavior.
Do you think the Fed hits pause?
That's an open question. I mean, you're hearing a lot of Fed speak suggesting just that. There's been no Fed speaker that I've heard recently that has come out definitively and said inflation is going in the right track and we're confident enough that we will lower rates in December. There's still uncertainty around that decision.
It's going to be an interesting few weeks, that's for sure. Nela, it's good to see you. Nela Richardson there of ADP.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.